Okay, let's dive right in. The entire global energy market is balanced on a knife's edge. And the reason why is this tiny strip of water that, let's be honest, most of us probably couldn't find on a map. Today, we're going to break down why the era of cheap oil is likely over for good, and why $100 might just be the new floor, not the ceiling.
So here's the central mystery we're going to solve today. A massive geopolitical event has just gone down. We're talking a full-on blockade in the world's most critical energy choke point. But if you just glanced at the headlines, you'd think the market barely even flinched. It just shrugged. And that right there is a fascinating puzzle. The real shockwave is building just under the surface, totally hidden from plain sight. And in this explainer, we are going to pull back the curtain and show you exactly what that means for you and for the markets.
All right, here's our game plan. To get to the bottom of this, we have to start with the physical reality of this 21-mile choke point. From there, we'll decode the secret language of the futures curve. That's where the pros are really looking. Then, we'll track the ripple effects, what I'm calling the screaming spreads, and we'll expose the playbook the big institutions are using to play this. And finally, we'll tie it all together to show you why $100 oil really is the new floor. First things first. Before we even talk about finance or markets or portfolios, we have to understand the geography. Because in this story, geography is everything. We are talking about one of the most strategically important places on the entire planet. This right here is the Strait of Hormuz. It is the only way for ships to get from the Persian Gulf out to the open ocean. For global energy, it's not just an artery, it is the aorta. You've got countries like Saudi Arabia, the UAE, Qatar, Iran. They all depend on this single, narrow waterway to get their oil and gas to the rest of the world. So, what happens when someone suddenly turns off the tap?
Well, at its narrowest point, the shipping lane in the strait is just 21 miles wide. That's it. It is a fragile, tiny gap that the entire global economy leans on. This isn't some vast ocean. It's a tight corridor that can be controlled or disrupted with terrifying ease.
And through that 21-mile gap, just 1/5 of the entire world's daily oil supply. 20%. Let that sink in for a second. That is an almost unbelievable amount of risk concentrated in one single spot. You close this thing down, and you basically turn off the lights for a huge portion of the global economy, especially for major importers in Asia like China, Japan, and South Korea, who are critically dependent on that flow.
And the fallout from the blockade is immediate, and it is catastrophic. Right now, there are about 1,000 vessels just stranded. You've got 800 trapped inside the Persian Gulf trying to get out, and another 200 stuck outside trying to get in. Trade in the region hasn't just slowed down, it has been effectively paralyzed. This is the physical reality we're dealing with.
So, if the physical situation is this dire, why isn't the market in a complete lights flashing, sirens blaring panic? Well, it's because the real story isn't on the 6 o'clock news. No. It's hidden in the complex data of the futures market. And if you know how to read it, it's telling a much, much more alarming story.
Okay, quick primer. What are we talking about here? A futures market is basically a place where people make bets on the future price of something, like oil. A refiner might buy a contract to lock in a price for crude they're going to need in 3 months. A producer might sell a contract to guarantee a price for oil they haven't even pumped yet. It's all about managing risk down the road.
Now, this is the key. A futures market can be in one of two states, contango or backwardation. Most of the time, the market is in contango. It's calm, it's normal. It just means oil for delivery in the future costs a little more than oil today. But sometimes the market flips into backwardation. And this, my friends, is a massive flashing red flag. It means the price for oil right now, for physical delivery today, is higher than the price for oil in the future. It is the market literally screaming, I don't care what it costs in 6 months, I need barrels of oil right now at any price.
And this is exactly what we are seeing today. The oil futures curve isn't just in backwardation, it's in what the pros call extreme backwardation. Just look at these numbers. A contract for oil delivered now is trading near $96, but a contract for delivery at the end of the year, it's barely $75. That's a massive $20 premium for immediate supply. This isn't a market flinch. This is a silent four-alarm fire. The market is paying a king's ransom for the few barrels it can get its hands on today, and that signals a true crisis of physical scarcity.
So here's the crucial part.
That extreme stress we're seeing in the futures market, it's not staying contained. It is boiling over, and it's causing these massive dislocations in other professional market indicators. These are the numbers that don't make the headlines, but they show just how deep the panic is for the people who actually have to move physical oil around the planet.
Let's start with the Brent WTI spread. Think of it like this. Brent is the international price for oil that travels by sea, the kind that goes through the Strait of Hormuz. WTI is the US domestic price, which is mostly landlocked and safe from all this. Normally, Brent trades for maybe $3 to $5 more than WTI, but in this crisis, that spread has blown out to $25. That is the market putting a huge explicit price tag on any barrel of oil that isn't trapped behind that Hormuz choke point.
And that financial spread translates into a shocking real-world cost. If you want to charter a very large crude carrier, a VLC, one of those supertankers, the daily rate has hit an insane $800,000 a day. Think about that. Almost $1 million a day just to rent the boat. All because the few ships available outside the Gulf are in extreme demand to move oil on these longer alternative routes.
But this one might be the most staggering number of all. The cost of war risk insurance for any tanker that would even dare to operate near the region has skyrocketed by 2,400%. It's gone from around $48,000 for a trip to over $1.2 million. At those kinds of rates, it's just not economical to even try. It's basically an insurance blockade on top of the physical one.
Okay, so how does all this chaos actually translate into an investment strategy? This is where we get to the brutal truth. There is a massive gap between how most retail investors try to protect themselves in an oil crisis and how the big institutional players actually find their edge, their alpha.
So the typical move for a retail investor, right, is to go buy shares in the huge oil companies like Exxon or Chevron. And it makes sense on the surface. Oil prices go up, oil companies should make more money. But the institutional playbook is, well, it's way more sophisticated. They're not just betting on the price of crude. They are exploiting the dislocations this crisis is causing, specifically in refining margins and in the energy services sector.
The key metric they're watching is called the 3-2-1 crack spread. Now, it sounds complicated, I know, but the idea is actually pretty simple. It's basically the profit margin a refiner makes. They take in 3 barrels of crude oil, they crack it into more valuable stuff, like 2 barrels of gasoline and 1 barrel of diesel, and the spread is their profit on that whole transaction. And here's where the real money is. That crack spread has gone parabolic. It is more than doubled, rocketing from an average of around $20 a barrel to over $52. Why? Because U.S. refiners get to buy that discounted landlocked WTI crude, but they sell their finished gasoline and diesel at prices tied to the much, much higher international Brent price. They are literally capturing that massive spread we saw earlier. They are minting money right now. The second part of the institutional strategy is what's called the picks and shovels play. Like in a gold rush, don't bet on who finds the gold, bet on the company is selling the picks and shovels to all the miners. In this case, that means energy services companies like Halliburton. With 20% of global supply suddenly at risk, the world is desperately scrambling to find new production anywhere else. And companies like Halliburton, with their global operations and their high-tech gear, are absolutely essential to bring that next wave of supply online.
Okay, let's bring this all home. We've seen the physical reality on the ground, or on the water. We've seen the financial panic hidden in the data. And we've seen the professional playbook. Now we can pull all this evidence together and make the case for a permanent structural shift in the price of oil.
So here's the case, laid out plain and simple. The physical bottleneck at Hormuz has forced the market to reprice geopolitical risk for the long term. The financial markets, through backwardation, are screaming that we have a lasting supply shortage. The ripple effects in shipping and insurance prove this isn't some temporary blip. It's a deep, systemic shock. And finally, the profit centers have fundamentally shifted, showing us who the real winners are in this new era. So the bottom line is this. We have to stop thinking that prices are going to go back to normal, back to that $70 or $80 range. The market has now permanently priced in what's called a geopolitical risk premium of at least $10 to $20 per barrel. This isn't just speculation. It's a structural repricing of the very real risk of getting oil from point A to point B. $100 isn't a ceiling anymore. It's the new baseline for stability. And all of that leaves us with one final, and I think, pretty provocative question. This isn't a temporary crisis. This is a fundamental regime change in the global energy market. The risk that was always theoretical has now become a hard reality, and it's been priced in for the foreseeable future. So the real question isn't about when things will go back to normal. The real question is your portfolio prepared for this new normal?